Thank you, Shobji. Hello, students. Good morning. Very warm welcome to today's session. Topic for today is India's 7th statement of the cash flows. So we will quickly cover key concepts, whatever we have learned in our main classes about the statement of cash flows. What is the objective? How we prepare the statement of cash flows? What are the key points which we need to keep in our mind while preparing the cash flow statements, right? And then we will do some quick full-fledged cash flow preparation questions so that we master the art of preparing the cash flow statements. So that's the objective. So why, the statement of cash flow is prepared? What is the objective of preparing the statement of cash flows? So we prepare the balance sheet, like we prepare the P&L, we also prepare the statement of cash flows in our, financial statements, right? So balance sheet depicts the balances of your assets and liabilities as on the reporting date, right? Statement of profit and loss depicts the picture of financial performance of the company over the period, right? And the statement of cash flows tells you how the cash is generated by the company and where the cash has been utilized by the company during the year, so that it gives a clear picture from which all sources the cash has been generated during the year and to for which or all sources the cash has been utilized, right? So it gives it shows the quality of the earning as well. So suppose the company is showing the profits as per the statement of profit and loss account, but they are not able to showcase the operating cash flows with more or less similar amounts, then it means that company earnings quality is not good, right? So company is showing the profits continuously in the P&L statement over the years, but enough cash has not been generated in the statement of cash flows, right? So this there might be multiple reasons for that, right? So that needs to be further looked after or investigated, right, by the users. But a statement of cash flows prima facie serves the purpose of telling the users of the financial statements, boss, these are the sources of the cash flows and these are the utilization of the cash flows over the period, right? So when the users of the financial statements looks at the statement of the cash flows, so they are able to see what is the ability of the entity to generate the cash and cash equivalents during the year, and what are the needs of the entity where the cash has been utilized or cash will be utilized in general, right? And what are the timing and certainty of generating of those cash flows, right? So these are the points which we can assess by looking at the cash flow statement, right? Now, how we are going to prepare and present the cash flow statement? So generally, statement of cash flows can be prepared via two methods, right? So there is a direct method, there is an indirect method, but most of the companies, prepare and present the cash flow statement using the indirect method, right? Both the methods you must have studied. So in both the methods, only the starting point is different, right? But at the end of the day, we have to present our cash flows from three activities: operating activities, investing activities, and financing activities, right? So what do we mean by operating activities? Any guesses? Which all activities are operating activities? So operating activities are those activities uh, for which are part and parcel of the main business of the company, right? And if any activity is not the investing activity or not the financing activity, then that will be regarded as operating activity. So operating activity is a kind of residual category, right, for the purpose of the statement of cash flows. So we have to be very clear that whether a cash flow is generated from an investing or financing activity. If that is not the case, then by default, that activity will belong to the operating activity category. Is that clear? Right? Now, so in that case, we need to understand the meaning of investing activity, right? So what do we mean by investing activity? So investing activity means company is doing some investment, right? So what are the possible investments company might have been doing during the year? For example, purchase of property, plant and equipment, right? Purchase of intangible assets, purchase of investment property. So all these are investments for the company. So whenever the company purchases any machinery or acquires any land or acquires any building, so what do you think company is doing? So basically company is deploying the cash into creation of certain long-term assets, right? And those long-term assets will give the future economic benefits to the company over the multiple periods or years, right? So that is a kind of investment the company is making today in order to generate the cash flows tomorrow and day after tomorrow, right? So that's the objective. So company is doing the investment, right? So if the company is purchasing the property, plant and equipment, then it means the company is doing the investment. So there is a cash outflow, right? And at the same time, if during the year company sells any machinery or any property, plant and equipment or any intangible assets or any such investments, right? Then what will happen? There would be a cash inflow to the company, right? By virtue of selling of those assets, right? So that is regarded as the investing activity. So investing activities are the acquisition and disposal of long-term assets and other investments not included in the cash equivalents, right? What are the other examples of investing activity? For example, purchase of bonds during the year, purchase of equity shares in another company, acquisition of interest in the joint venture, acquisition of interest in the subsidiary, right? Acquisition of interest in an associate, right? All these are also part and parcel of the investing activities for the company. Is that clear? Right? Now, if we are generating any returns on these investments, so those returns will also form part of the investing activity. For example, if I have made a investment in bonds of some other company and I'm receiving the interest on that, then where do I classify the interest income, interest received during the year? Under the investing activity, right? If I am receiving the dividends on my equity shares investments in other company, where the dividend will come? Investing activity, right? So this is how the investing activity needs to be clearly identified and presented on the cash flow statement, right? Then what is the financing activity? Financing activities, as the name itself suggests, that we are getting finance arranged for the company, right? So either we are issuing the equity shares or we are issuing the preference shares or we are taking the loans from the banks or we are issuing corporate bonds or we are issuing any debt instruments in the market to generate finance for the company, right? So all these activities are forming part of the financing activities, right? So financing activities are activities that result in changes in the size and composition of the contributed equity and borrowings of the entity. So suppose if the company has issued 100 crore of equity shares in the market during the year, right? So where you will take it up in the cash flow statement? Financing activity, right? So any sort of change in the capital structure of the company indicates that some financing activity has been carried out during the year, right? Now, if I am paying the interest on my borrowings, where that interest will go? In the financing or in the operating activity? What do you think? Financing, right? Because that is the borrowing cost I am incurring. So that will be classified under financing activity, correct? If I am paying any dividends to my shareholders, preference shareholders and equity shareholders, where that dividend will go? Financing, right? But this classification might be changed for a particular sector. For example, financial sector like banks, NBFCs, mutual funds, right? So all these companies are actually into the business of arranging finance and earning the interest or dividends and returning them, right, during the year. So for them, money is the product, right? Because they are giving loans, earn the interest, right? And that is the business. for them. For example, banks, NBFCs, right? So they are into the business of lending money and earning the interest over there. So for them, interest earned on the loans given, right, is a operating activity. And on the similar lines, if they have taken the deposits from the small depositors and they are paying the interest on that, so that will also be regarded as the operating activity for them, right? Because they are into the business of taking deposits and lending money and earning interest, differential income, right? So that is the prime business for them. Correct? So we need to be very clear if in the examination hall, what is the nature or business model of the company in the question, right? So we shouldn't be jumping on preparation of the cash flow without looking at the nature of the company or nature of the business of the company. So for example, if in the examination hall question clearly says ABC Limited is into the NBFC business or a bank, suppose the question starts with a bank, then it means it is a financial sector company, and we need to be mindful while doing the classification of investing and financing and operating activities of the different cash flows, right? Otherwise, we will end up preparing the cash flow correctly. It will be matching anyway, but our classifications will go on the toss. Correct? Perfect. Now, what do we mean by the cash and cash equivalents? Because once we are done with the classification of all our cash flows into the operating, financing, and operating, investing, and financing, lastly, we need to reconcile our the cash, with the cash coming in our balance sheet, right? So what do we mean by cash and cash equivalents? So cash means the hard cash which you are having, right? For example, you are having the INR in your bank, or you are having the cash in your drawer, or you are having any other cash in any other currency, right? In any of your foreign bank accounts. So that is regarded as the cash. And what are the cash equivalents? So cash equivalents are short-term, highly liquid investments. For example, money market deposits, right, are readily convertible to a known amounts of cash. So there is insignificant risk that the value of our investments will fluctuate, right? So they are like, we can clearly say that what amount of cash we will be receiving when we liquidate these short-term investments, right? And are subject to insignificant risk of change in value, right? So that I have already said, and are not for investment purposes. So the purpose of making these deposits is not to invest, right? But the purpose is because we do have some idle cash sitting with us, so we can deploy them into some short-term investments for the time being when we are not actually using that cash for our business purposes, right? And has a short maturity of say 3 months or less from the date of the acquisition. So from the date of the acquisition is the keyword, right? So if, for example, we are preparing the cash flow statement for 31st March, right? And short-term deposits we had purchased, say, suppose in the month of April, or sorry, in the month of February, right? And from the February, it was 5 months or 4 months, but from the end of the March, it is 3 months, right? Now, few people might be confused because they are getting matured within 3 months from the reporting date, right? So they might be treating them as, cash equivalent, while it is not the right thing to do, right? So from the date of the acquisition of those deposits, we need to see what is the status, right? So if that is the within 3 months, maturity is within 3 months, then they will be regarded as the cash equivalents, otherwise not. Is that clear? Right? Now, what is the exception? Equity investments are excluded from cash equivalents. Why? Suppose if we have shares, invested money in some shares of other company, then those will never be regarded as the cash equivalents. Even if, even if we want to liquidate those investments within a 1 month or 2 months, right? Why? Because we cannot guarantee what amount of cash we will receive on maturity, because there is no maturity as such for the equity instruments, number one, and what amount of cash we will receive when we plan to sell those equity shares in the market, because equity share price are, subject to high fluctuations, right? So that is not meeting the definition of cash equivalents at all, right? Okay. Now, cash flow from operating activities, what are the possible examples? For example, cash receipts from the sale of the goods and rendering of services, cash receipts from the royalties, fees, commission, and other revenue, payments to the supplier for the goods and services, payments to the supplier, payments to other creditors, or payments to employees who are, working in your company, right? Receipts and payments of an insurance entity for premiums and claims, payments and refunds of income taxes, receipts and payments from the contracts for trading purposes, right? So all these are part and parcel of your normal business activities. So whatever the cash is coming in from these activities, or whatever the cash is going out for these activities, will be classified under operating activities, right? Investing activities, I already discussed. Purchase of machinery, purchase of property, plant and equipment, purchase of intangible assets, purchase of investment property, purchase of equity shares, purchase of bonds, right? Purchase of any other investments, making FD with the bank. So all these activities are investing activities, and redeeming them or selling those assets will be resulting into the cash inflow for the company, right? And financing activities, issuing equity share capital, issuing bonds, issuing debentures in the market, right? And repayment of the borrowings, repayment of the bonds, right? Payment of interest on the bonds or on the loans, right? Distribution of dividends to the equity and preference shareholders. So all that is financing. Now, what are the rules regarding the presentation of cash flow on a net basis in certain situations? Any guesses? So there are certain situations when the cash flows can be presented on a net basis instead of the gross basis. So generally, the general rule for the preparation of the cash flow is that we shouldn't be netting off any of the cash inflows with any of the cash outflows, right? So that's the rule in general. But there are certain situations or exceptions where the net cash flow can also be presented in the cash flow statement, right? So what are those? So suppose if I am a bank or the financial institution like NBFC or bank, then what would be happening during the year? So I would be receiving, the bank will be receiving, cash and making payments for acceptance and repayment of the deposits. So there are millions of customers who would be coming into the bank for making some deposits, and there are millions of customers who would be coming to the bank for taking cash out of their deposits, right? So withdrawing or redeeming their deposits. So there are numerous transactions for the deposits made during the year and the deposits redeemed during the year, right? For a bank or NBFC, right? Because there are millions of customers, right? So in that case, what will happen? So if we go and apply the gross rule, that how much total deposits have been uh, created during the year, right? So what is the money flowed in and what is the money flowed out by virtue of a redemption of. So this information will not give any further insights or any additional, important detail to the user of the financial statement, right? So the statement of cash flow, if simply presents net cash from the deposits received and deposits redeemed during the year, so will that information not be enough for us? Yes, because on a net basis we will be bank during the year, which how much cash has gone out of the bank during the year, right? So that is the enough information for us, rather than actually looking into how much is received and how much has been redeemed during the year, right? So in that case, the net presentation is allowed, right? So please advances given during the year and repayment of those loans during the year, right? So whether the bank is receiving the deposits and redeeming the deposits, or whether the bank is giving the loans during the year and receiving the EMIs or the payments against those loans. So we don't need to present them on a gross basis. We can present simple net basis in the case of bank or NBFCs, right? Is this clear? Right. Now, in case of other companies who are not into the financial institution business, right, or other than financial institution, so in those cases, what are such situations where net presentation could have been done? So cash flow arising from operating, investing, or financing activities may be reported on a net basis. Number one, cash receipts and payments on behalf of the customer when the cash flows reflect the activities of the customer rather than those of the entity. So the situation would be examples of the cash receipts and payments referred to in above para are the acceptance and repayment of the demand deposits of the bank, funds held by customers by an investment entity, and rents collected on behalf of and paid to for other owners. So, for example, if any company is into the business of managing properties, right? So they are taking out properties from different owners and giving them on rent, right? So they are collecting rent from the users who are using those properties, right? On taking on rent, and they are paying the monthly rentals to those owners to whom the property belongs, right? So in that case, what will happen? So they are collecting the rents from millions of users during the year, and they are paying the rent to, many, property owners. So in that case, that could have been presented on a net basis. So what is the net, they have generated, right? Similarly, funds held for customers by an investment entity. So mutual funds, right? So they are the investment entity. So they hold the funds on behalf of their investors, right? So there might be many customers who are coming and doing the investments with the mutual funds and the SIPs, and there might be many customers who are redeeming or withdrawing from the investments, right, and stopping their SIPs further, right? So they can also go ahead and present on a net basis, right? Now, another situation, cash receipts and payments for items in which the turnover is quick, the amounts are large, and the maturities are short. So what that situation would be? So in this case, what is happening? Cash receipts and payments are advances made and the repayment of principal amounts relating to the credit card customers. So suppose if a company is into the credit card business, for example, SBI credit card, right? So that is a separate legal entity who is purely into the business of credit cards, right? So what that company would have been doing. So they are issuing the credit cards to millions of customers, right? And millions of customers are using those credit cards for making their purchases, right? And then they would be repaying those credit card payments to the company, right? So they can simply present on a net basis how much payments the credit card company has made on behalf of those customers and the payments they have received from the credit card customers, right? Purchase and sale of investments. So any company who is making a lot of purchases and a lot of sales of equity shares or bonds during the year because they are simply doing the trading in the equity shares of other companies. So do we need to present on a gross basis that how much total investments we have made during there and how much total investments we have sold? No, we can present it on a net basis that net sale proceeds from the trading activity in the equity shares, right? So there is no need to present on a gross basis. Other short-term borrowings, for example, companies, taking short-term borrowings and repaying them, taking short-term borrowings and repaying them, right? So they can simply say how much is the net. Are they owing net borrowings during the year, or are they, not owing, right? So there is no need to present a gross presentation in these cases as well. So these are the few exceptions for net presentation where we can do the net presentation. Otherwise, Apart from these, everywhere we have to do the gross presentation, right? So gross presentation is the prima facie requirement while preparing the cash flow statement, but in certain cases, net presentation is allowed. Is that clear? Perfect. Foreign currency cash flows. How to deal with the foreign currency cash flows? We will do a numerical on this. So maybe I will discuss this concept there, right? Along with the practical. And largely all these things are defined only. So interest and dividends I have already discussed in case of financial institution and in case of other entities, right? And loss of control, we will do a numerical. So let's go and start the numericals now. Please let me know if the screen is up and you are able to see the screen. Yes. Okay. Thank you. Now, first question. Company has provided the following information regarding the various assets held by the company on 31st March 2001. Find out which of the following items will be part of the cash and cash equivalents for the purpose of preparation of the cash flow statement as per the guidance provided in India 7. Fixed deposits with SBI, 12%, 3 years maturity on 1st of January 2004. Tell me where you are going to present it. It is a fixed asset, fixed deposits with SBI, Samanathan. Yeah, long-term investment because maturity is 3 years, right? So is it a part of the cash and cash equivalents? No, right? It will not be part of the cash and cash equivalents. It is my investments, right? Second, fixed deposits with HDFC, 10% is the interest rate. Original term was 2 years, but due for maturity within 3 months from the reporting date. 3 months maturity? No, no, because we will not be looking at the maturity from the reporting date. We will be looking at the maturity from the date of acquisition, right? So original maturity was 2 years, right? Redeemable preference shares. Redeemable preference shares acquired on 31st of January and the redemption is due on 30th April. So preference shares, redeemable preference shares is a part of cash and cash equivalents. How come? Rational, insignificant risk, not there. Oh, you are answering other items along with. Okay, okay, okay. Okay. So let's discuss. I think you have answered all, right? So redeemable preference shares in ABC Limited, it will be included because they are due within 90 days from the date of the acquisition, right? Cash balances at various banks include, cash balances at various banks include, cash balances at various banks include. What are those cash balances? So all branches of all banks in India, all international branches of Indian banks and branches of the foreign banks, right? So it doesn't matter whether my cash is sitting in the Indian bank or it is sitting in the a foreign bank, it is sitting in the branch in India or it is sitting in the branch in foreign country, right? It doesn't matter. It is a cash for me, right? Bank overdraft of SBI Fort branch and treasury bills, 90 days maturity. So what we will do with these items? Now, there is one more item which we need to recall. So if, treasury is an integral part, right? Basically, few of the companies are, relying highly on taking the bank overdrafts and repaying them, right? Because they are managing the cash that way, right? So that is an integral part of their cash management function, right? So in that case, bank overdraft will be considered as a part and parcel of the cash and cash equivalents, right? But if that is not the case, then bank overdraft will not be considered as the part and parcel of the cash and cash equivalents. Are you able to recall this point from your regular interaction in your regular class? So, as per the Ind AS 7, if an entity considers taking bank overdrafts and repaying them as an integral part of their cash management, right, or treasury function, then it will be considered while preparing the cash flow statement as a part of the cash and cash equivalents, otherwise not. Otherwise, it will be a short-term liability. Is that clear? And treasury bills, 3 months maturity include, right? So that was a quick recap. Now let's do the question and we will be seeing how we are going ahead with the preparation of the cash flow statement. Following is the balance sheet of the Kuber Limited for the year ended 31st March 2002, which is presented in lakhs, right? And I'm reminding one key point again. Whenever in the examination hall, we are looking at any of the statements which are given in the question, be it the balance sheet or the P&L or whatever, right? So always be mindful that where the current year is coming and where the previous year is coming, right? Because sometimes what happens in the examination, because we are not paying attention to the order of this, right? We might end up doing the mistakes while preparing the cash flow statement, while calculating the working capital changes. Are you agreeing with me? So if 2002 is the current year and 2001 is the previous year, right? And suppose I simply reverse the order, right? And if you don't pay the attention, then your cash flow statement will go wrong, right? So while in the examination hall, we should be paying attention to the order of the columns given in the examination question, right? That is very crucial. Otherwise, in spite of being right on every concept, our cash flow statement will go out. Clear? Okay. So, property, plant and equipment, 13,000. Previous year, 12,500. So, similarly, many other assets are given. And then current assets, then total of the current assets, equity liability, total of the liabilities, and then current liabilities, total of current liabilities, and then total of equity and liabilities, right? So all this information is given in the balance sheet of the Kuber Limited, right? Now, additional information. Profit after tax for the year ended 31st March 2002 is 4450 lakhs. Interim dividend paid during the year is 450 lakhs. Depreciation and amortization charged in the statement of profit and loss during the year are as under: property, plant and equipment 500 lakhs, intangible assets 20 lakhs. So these are the depreciations which are charged during the year on the property, plant and equipment and intangible assets. During the year ended 31st March 2002, two machineries were sold for rupees 70 lakhs. The carrying amount of these machineries as on March 31, 2002 is 60 lakhs, right? So two machineries have been sold during the year for how much? 70 lakhs, and carrying amount of those machineries was 60 lakhs. Income taxes paid during the year is 105 lakhs. Non-current assets and current assets and liabilities are related to the operations of the Kuber Limited and do not contain any element of financing and investing activities. Okay. Using the above information of the Kuber Limited, prepare a statement of cash flows under the indirect method. So this is a full-fledged question, right, of preparing the cash flow statement, which with a lot of adjustments, right? So if we are able to crack this question, then it means we are good on the cash flow statement preparation concepts. So would you like to try your hands on this quickly, or should I be discussing the solution? Are you trying? Okay, let's do this way, that I discuss this first solution, then the next practical you try completely, right? So first question, let me discuss straight away. Okay. So with this balance sheet and adjustments, what we need to see, we should start with the indirect method, right? For the indirect method to start with, we would be needing the net profit after tax, right? So net profit after tax is given in the question 4450, right? Here it is, the very first line, very first adjustment, right? Here it is, 4450. So we'll start with net profit after tax 4450. Then income taxes paid during the year is also given in the adjustment for 105 lakhs. That we will be adding, and we will be computing the net profit before taxes for 555, right? Now in the adjustment, it is given that the depreciation has been charged during the year is 500 plus 20. So 520 is the depreciation which has been charged on the machinery and the intangible assets. So that is already given in the adjustment. So this is a non-cash item. And while preparing the cash flow statement, we always adjust all the non-cash items, right? So 520 is added back. Now we need to compute the gain on sale of machinery, loss or gain, whatever it is. We need to compute that, right? So that we will compute, and increase in the deferred tax asset, that we will compute. So these are the two adjustments which we need to compute in our separate working notes first, right? So what is the gain on the sale of the machinery? So let's go above. During the year, two machineries were sold for rupees 70 lakhs, and the carrying amount of these machineries was 60 lakhs. So machinery was sold at a profit of rupees 10 lakhs, right? So how much gain we must have recorded already in our P&L account? 10 lakhs. So that I am going to deduct it from here, right? So I will be adjusting that, because this 10 lakh is already sitting in my P&L, which I have taken from the statement of profit and loss, because this entry must have already been passed in my books, right? So 10 lakh I am deducting from this profits, and then adjustments for the tax assets. So let's go to the, where it is. Here it is. So deferred tax assets net. So 855 is the current, and previous year it was 750, right? So how much is the delta? So that delta we are adjusting from here. That is, we are deducting it from this profit because this entry has already been passed. Now, after all these adjustments, we arrived at 4960 as the profits for available for the cash flow statement, right? Now, we would be doing the working capital adjustments, right? So we would be doing, increase or decrease in the assets. So whenever there is a decrease in any of the asset item, we are going to add, and whenever there is a increase in any of the asset item, we are going to deduct, right? So that we need to keep in our mind that if the assets are decreasing as compared to the previous year, that will be added. And if the assets are increasing as compared to the previous year, then that will be deducted for the purpose of making these adjustments. And opposite, the signage for the liabilities items, right? So one by one, from the balance sheet, we would be doing all these adjustments, right? So decrease in the financial assets, increase in other non-current assets, increase in other current assets, right? Decrease in other non-current liabilities, increase in other current liabilities, increase in trade payables. So from the balance sheet straight away, you are able to calculate these items, right? And once you are done with these adjustments, right? Additions and deductions, then lastly, you will deduct the income tax again because income taxes are paid during the year. So that is a payment which you have actually made, right? And this is the cash from operating activities, 4025. Any doubts until now? Right? Now, somebody may ask that why we had added 105 above and why we are now deducting 105 now. So we could have skipped altogether the adjustments for the income tax, right? So we have added the same amount above and we have deducted the same amount now. So in this question, because the provision of the income tax is not, part and parcel of the question, that's why we are simply adding the same amount and deducting the same amount, right? But sometimes it happens that we do have the provision for income tax liability or advances of income tax paid during the year, information available in the question. So in that case, we might be adding up a different amount above and we might be deducting the income tax actually paid during the year here, right? So that is why we cannot skip this adjustments. Unfortunately, the amount is same in this question, right? Are you able to understand what I'm trying to communicate? Right? So that's why we shouldn't be thinking that why we are making this unnecessary addition above and deduction below. So conceptually, we are adding the above non-cash income tax expense, and here we are deducting the actual cash outflow for the payment of income tax during the year, right? Now, once we are done with the calculation for the operating activities, then we'll start for investing activities. So for the investing, in the adjustments, it is given machinery sold for 70 lakhs. So 70 lakhs is the cash inflow. So that's why positive. And then purchase of machinery, we need to calculate, right? So in the adjustment, we will go back to see what has happened. During the year ended 31st March 2002, two machineries were sold for 70 lakhs. Okay, this adjustments we have already made. Now, there are some information given over here, right? Depreciation and amortization charge in the statement of profit and loss during the current year are as follows. So 500 lakhs is the depreciation and 20 lakhs is the amortization on intangible assets, right? Now we will see what were our opening and closing balances of these property, plant and equipment and intangible assets, right? So here it is. So 12,500 was the opening balance, right? And 500 is the depreciation charge, 70 is the sale value, and the carrying amount was 60. So looking at all these information and the closing balance of 13,000, can we quickly compute how much property, plant and equipment has been purchased during the year? Are we able to do so? So we have the four pieces of information available: the opening balance, the closing balance, the depreciation charge during the year, and the sale of machinery during the year. So can we quickly construct the account of the property, plant, and equipment to come up with how much purchases we have made for the property, plant, and equipment during the year? Yes or no? Yes. Now, how do we come to know that in what situations we might be needing this working to do? So basically, generally in all the questions, we might be needing to work out whether there is any purchase or not, because sometimes in the question, it is given straight away that this much is the sale, this much is the purchase during the year. Sometimes only the sale information, or sometimes only the purchase information is given. So we always need to construct the account for the property, plant, and equipment in order to see if there are any transactions which are not part and parcel of the question additional adjustments, which we need to identify from constructing this account, right? So that is a check we always need to have, right? So with this information, we will be able to come up with the amount, right? So how that amount is come up? So there are two choices. If you are super quick and you are comfortable of doing the quick calculations instead of creating the work notes, right, separately at the below of the solution, then you can present your calculations right here, right, in this manner. But sometimes, to be very short on calculations, if we do any sort of mistake here, right, then we will get a wrong amount, right? So that will impact our cash flow statement. And once our cash flow statement doesn't tally, we will spend more time unnecessarily to reconcile it, right? So I always suggest, don't cut your time on presentation of the working notes while you are preparing any of such questions like cash flow statement, consolidation questions, right? Because doing the short calculations sometimes lead to mistakes, right? So if you are comfortable, you have practiced a lot this way, then certainly you can go ahead, but don't use a different practice in the examination hall which you otherwise were not using while doing the practice at home, right? So either practice it consistently at home as well so that you are used to it. Otherwise, simply create the account in the working note for the property, plant, and equipment. Right now, let's start with. So closing balance is 13,000, opening balance is 12,500, right? Minus 500 is the depreciation charge, minus 60 was the carrying amount of the asset sold. So 12,500 minus depreciation minus 60. And this I will be deducting from the closing balance in order to arrive at the purchase value of the property, plant, and equipment during the year. Right. So this is how I will be getting it. Same logic I apply for the intangible assets. So right, so 30 minus 20, because there is no sale. So simply I'm deducting the depreciation and I will be deducting it from the closing balance. So I will be getting the purchase of intangible assets during the year, right? So this is how these two items I am able to derive while being vigilant on the question rather than, waiting for this information to be made available in the adjustments only, right? Sale of financial assets and investments. So closing balance minus opening balance, simple, right? So this is how cash flow from investing activities I will be able to compute. Now, because it is a negative amount, so I will use the word on my statement of cash flow as cash outflow. So sometimes, students do the mistake in the examination hall, irrespective of the fact whether the amount they are deriving is positive or negative, they always use the word cash flow from investing activity. So if I use the word cash flow from investing activity and my amount is negative here, then I will lose at least 1 mark because my nomenclature is not aligned with the signage of my amount, right? So I have to be clear in the examination hall that I'm using these words correctly, right? So I shouldn't be using the cash from operating activities. I should be saying the cash generated from the operating activities, cash outflow from investing activities, right? Or if suppose if it turned out to be a positive amount, then I will say cash flow from investing activities, right? Is it clear? these are small points, right? So which we need to keep in our mind so that we don't lose unnecessary marks in our question, in spite of the fact we have prepared the cash flow statement correct, right? Okay. Now, the last leg of the cash flow statement is cash flow from financing activities, right? So in this case, what are the two adjustments? Number one, the dividends paid, which is given in the adjustments 450, and the long-term borrowings paid, right? So closing balance minus opening balance 3000. So this is the simple 3450, the cash outflow from the invest financing activity. Again, we are using the correct word here, cash outflow from financing activity, right? Then I will be seeing whether on a net basis what I am doing. Is it an inflow or outflow? If it is still outflow, I will use the word net cash outflow from all the activities, right? So this is the summation of operating, investing, and financing activities. Then I will bring in opening cash and cash equivalents from the balance sheet and the closing cash and cash equivalents from the balance sheet, and I will be able to match it up, right? So 400 minus 145 is also 255, correct? So this is how my cash flow is getting matched. Any doubts, queries in relation to this question or any of the item? Yeah, correct. So 145 minus 400 minus 255, right? So this is how we are going to present our cash flow statement. We need to keep an eye open that if there are any property, plant and equipment purchases or sales happening, right? Then we need to construct the account of the PP&E and intangible assets to see if there are any hidden transactions which are not clearly laid out in the adjustments, right, in the question, right? Otherwise, we will be simply missing them. And unless and until we treat them, our cash flow will also not tally, right? Okay, let's do this one. Question number 3. Z Limited has no foreign currency cash flows for the year 2001. It holds some deposits in the bank in the USA. The balances on 31st December 2001 and 31st December 2002 were US dollar 1 lakh and US dollar 1 lakh and 2000 respectively. The exchange rates on December 31, 2001 is US dollar 1 is equal to 45 rupees. The same was on US dollar 1 is equal to 50 rupees on 31st December 2002. The increase in the balance was on account of interest credited on 31st December 2002. Thus, the deposit was reported at rupees 45 lakhs in the balance sheet at the end of the 2001. It was reported at 51 lakhs in the balance sheet at the end of December 2002. How these transactions should be presented in the cash flow statement for the year ended 31st December 2002 as per Ind AS 7, right? Because the question asked is you need to tell how this will be presented. So you don't need to, present or prepare the relevant extract of the cash flow statement. There is a discussion required, right? So how you are going to present this transaction? So you need to articulate, right, the answer. So let's quickly understand. So what is happening? So I was holding $1 lakh on which $2,000 interest was given to me for the 1 year, right? So $2,000 is my interest income in dollar terms. 1 lakh was the deposit. Because my dollar rate is fluctuating from 45 to 51, right? 45 to 50. So my balance is also fluctuating from 45 lakhs to 51 lakhs, right? Now, the profit and loss account was credited with $2,000 of the interest income at the end of the year. So I will be using the 50 rupees conversion rate in order to arrive at the income in INR terms. So in INR terms, $2,000 is equivalent to 1 lakh rupees towards interest income, which I have received on my deposit in the foreign bank. It was credited by the exchange difference of US dollar 1 lakh. That is 50 minus 14. So that is 5 lakh. So 5 lakh is the US currency, dollar currency difference on my deposit during the year. In preparing the cash flow statement, this 5 lakh, which is the pure exchange difference on my deposits, because I had a deposit of 1 lakh, which valued at 45 lakhs on the day one when I deposited, and it valued at the year end at 51 lakhs. 51 minus 1 lakh is the interest income. So 50 lakh is the deposit value. 50 lakh minus 45 lakh is the 5 lakh, right? So 5 lakh is my increase in the deposit in INR terms by virtue of increase in the dollar rate, right? Now, how this 5 lakh needs to be adjusted? So this needs to be deducted from the net profit before taxes while we are preparing the cash flow statement. Why? Because during the year when I was preparing my books of accounts, P&L and the balance sheet, the entry for this unrealized gain of rupees 5 lakh must have already been recorded, because I'm presenting my FD on the balance sheet at 50 lakhs, right? So in order to increase the value of the FD from 45 lakhs to 50 lakhs in the balance sheet, 5 lakh must have already been reported in my P&L as unrealized gain on the investments. Yes or no? Yes or no? Because this is an unrealized gain, so can I say this is a non-cash item? This is not yet realized in cash, so this is a non-cash item. And while preparing the cash flow statement, we adjust for all non-cash items. Yes or no? Yes. And what would be the adjustment? Because my profit as per the P&L already has this unrealized gain included. So I will be doing a deduction from that profit in my cash flow statement. Is that clear? Perfect. So that's why this treatment I am explaining that because this is the unrealized gain, this is a non-cash item, this is already part and parcel of my profit in the profit and loss account, because entry has already been recorded for this unrealized gain. Now for the purpose of cash flow statement, because we used to adjust for all non-cash items, I will be deducting it. And why I'm not adding it? Because it is already sitting in my P&L. So I'm deducting it to make my P&L free from non-cash items, right? Now, next. Cash flow arising from the transaction in the foreign currency shall be recorded in Z's functional currency by applying the foreign currency exchange rate amount between the two dates, right? Now, what does this mean? So 5 lakh adjustment I have already made above. Now, because this is a unrealized gain, right? So I still need to consider it at the bottom of the cash flow statement in order to reconcile my cash and cash equivalents with the balance sheet, right? Yes or no? Because this 5 lakh will also not be there in my investing activity, because this is not yet received. So it will not be forming part of my investing activity. Correct? So this there will be an adjustment for this non-cash item while reporting the cash and cash equivalents at the bottom of the cash flow statement, right? Any questions, any doubts? Okay, let's do question number 4. Company A acquires 70% of the equity stake in Company B on July 20, 2001. The consideration paid for this transaction is as below. Cash consideration of rupees 15 lakhs and 2 lakh equity shares having the face value of rupees 10 and the fair value of rupees 15 per share, right? So I am acquiring the 70% stake in Company B on July 20, 2001, and the purchase consideration is discharged by combination of the cash and non-cash items. So cash is 15 lakh, and 2 lakh equity shares are also handed over to them worth rupees how much? 2 lakh into में 15. 15 is the market price or the fair value. 10 rupees is the face value. So 2 lakh into में 15, right? On the date of the acquisition, company B had a cash and cash equivalent sitting in their balance sheet at rupees 2 lakh 50,000. On October 10, 2002, a further 10% stake is acquired by company B for the cash consideration of 8 lakhs. So 10% stake is further purchased for worth 8 lakh rupees. Advise how the above transactions will be presented while preparing the cash flow statement. So the question looks very small, but it is not that small, right? So are you able to recall any concept from your main discussion, main class on this aspect? So whenever the control is acquired, right? So what happens? If we are acquiring the control in any other company, right? Then what happens? We are simply investing, right? In other company, yes or no? We are purchasing the controlling stake in other companies. So that is a investing activity, operating activity, or financing activity. What this activity is? Okay. So let's read the literature given in the India 7 along with the paragraphs so that we are able to do the demarcation, what the standards requirements are in this case. So under para 39 of India 7, the aggregate cash flows arising from obtaining control of the subsidiary shall be presented separately and classified as investing activity. So we are acquiring the 70% stake, right? So 70% stake is the controlling stake. So it means we are obtaining the control, right? So once we obtain the control, that transaction is regarded as the investment activity for us, right? So whatever the purchase consideration we have discharged is the investing activity. Now, investing activity under the cash flow statement will be reported only for that component of the purchase consideration which is discharged in cash. Correct? So in the overall purchase consideration, how much is the cash discharged? 15 lakhs. Correct? And because we are paying the 15 lakhs, but we are doing the line by line consolidation of this company in which we are getting this 2 lakh 50,000 as well back to us, which is sitting in their balance sheet as the cash and cash equivalents. So what I will be doing, I will be deducting it 2 lakh 50,000 from the cash I am actually paying. So for the purpose of my cash outflow in investing activity, how much cash will be presented as cash outflow? 12 lakh 50,000. Is that clear? So purchase consideration, the cash component only will come in the cash flow statement. That is the very clear to us, right? Because cash flow statement doesn't contain any other transactions which are not in cash, correct? So equity share issuance is not a cash transaction, right? So that will anyway not come under my cash flow statement, right? Only the cash outflow on account of the purchase consideration discharge in cash will come. Now the gross purchase consideration I am paying for is 15 lakhs and 2 lakh 50,000 I am also getting by virtue of taking a controlling stake in the company, right? So 2 lakh 50,000 is also coming back to me from the balance sheet of the acquiring company, right? So net cash outflow, which should have been presented in my cash flow statement, is 12 lakh 50,000. Is that clear? Okay, let's go next. As per para 42, India 7. The aggregate amount of the cash paid or the received as the contribution for obtaining the subsidies is reported in the cash flow statement net of the cash and cash equivalents acquired or disposed of as part of such transaction. So that adjustment I have already made. So 15 minus 2.5 is equal to 12.5, right? So that's the standard requirement is. Further, investing and financing transactions that do not require the use of the cash or cash equivalents shall be excluded from the statement of the cash flows. So it means if there are any transactions which does not involve the cash or cash equivalent, that will not be part and parcel of the cash flow statement. So purchase consideration also has the component of equity shares being issued of the face value of rupees 10 at the fair value of rupees 15, 2 lakh equity shares. But issuing the equity shares is not the cash transaction, so that will not come under the cash flow statement anyway, right? Now, so for first leg of transaction, my cash flow statement will be presented like cash outflow under the investing activity for acquiring a controlling stake in the subsidiary, right? Now, as per para 42A, India 7, cash flows arising from changes in the ownership interest. What do we mean by change in the ownership interest? So we are already holding 70% stake and we are further acquiring 10% stake. So it means my ownership interest is changing. It was earlier 70%, now it is 80%. In a subsidiary that do not result in a loss of control shall be classified as cash flow from the financing activity unless the subsidiary is held by an investment entity as defined under Ind AS 110 and is required to be measured at the fair value through P&L. Now, what is happening in this para 42A of the Ind AS 7? So para 42A says whenever after acquiring the control in another company, if you are further purchasing any shares in that company or you are selling some stake in that company which do not result into the loss of control, right? So you are holding the control even after the second transaction, then that transaction will not be treated as a investing activity. That transaction will be treated as the financing activity. So that is the clear message from the standard. Now, what will happen for the next item, for the next purchase, which we have made of 10 lakhs? It will be presented as financing activity. So, in the statement of the cash flow for the year ended 31st March 2003, cash consideration paid for acquisition of additional 10% stake, rupees 8 lakh, right, which is given in the question, will be shown under the financing activity because I already hold the 70% stake and I am now just doing some additional equity transactions with the subsidiary, right? So whether I am purchasing additional stake or whether I am selling some stake without losing the control, it doesn't mean, right? So it will go under the financing activity. Is that clear? Yes, no. Any queries, any doubts? Okay. Let's move to the question number 5. Entity A acquired a subsidiary entity B during the year. Summarize information from the consolidated statement of the profit and loss and the balance sheet is provided together with some supplementary information. Consolidated statement of the profit and loss. So this is the consolidated P&L is given. Revenue is 3,80,000. Cost of sales 2,20,000. Gross profit 1,60,000. Depreciation 30,000. Other operating expenses 56,000. Interest cost 4,000. Profit before taxation 70,000. Right? Taxation 15,000. Profit after taxation 55,000. Consolidated balance sheet is also given. Again, we are paying attention which year is the current and which year is the previous, right? So that we don't do any mistakes while doing the working capital changes, right? So cash and cash equivalents, closing balance 8,000, opening 5,000. Similarly, trade receivable, inventories, property, plant and equipment, goodwill is also there. Total assets is big given, then liabilities, trade payables, income tax payable, long-term debt, and total liabilities, shareholders' equity, and the total liabilities and shareholders' funds, right? So this is all the information, P&L and the balance sheet given. Additional information is given. All of the shares of the B were acquired for 74,000 in cash. The fair value of the assets acquired and the liabilities assumed were inventories 4,000, trade receivable 8,000, cash 2,000, property plant and equipment 1 lakh 10,000, trade payables 32,000, long term debt 36, and the goodwill 18. Right. So these are all the assets and liabilities which are acquired by virtue of taking a controlling stake in B. Right. Prepare the consolidated statement of cash flow. So you are given the consolidated P&L statement, you are given the balance sheet, you are given some additional information. Now we need to prepare the consolidated statement of cash flows as per India 7. So would you like to try this question now? At least we will be able to see whether we are right in all our concepts for the purpose of preparation of cash flow statement. If we don't try, then probably we will not be knowing on which spots we are doing the mistakes. So I'm just waiting for few minutes for you to try this question on your own first. At least try to prepare the relevant extract of the cash flow statement, and then we will see how close we were. Waiting for your response in the chat box. Any luck with the answer? Okay. So let's see how we are going about this question. So first of all, we'll start with the cash flow statement, consolidated cash flow statement preparation, right? Extract. So we are given information about the profit before taxation as per the P&L, right? So that is the starting point for us, 70,000. So it is straight away coming from my consolidated P&L given in the question, right? Then I will be doing the adjustments for all the non-cash items I'm having. What all those items are? Depreciation, 30,000. So this amount, 30,000, is given in the question. Here it is, 30,000, right? And am I able to see any other non-cash items? So all other items are cash related only. So there, this was the only item in the question that was non-cash, right? Now, why I'm not making any tax adjustments in this case? Because I have already picked up the profit before taxation, right? Because this is already given to me profit before taxation. So I'm not doing any tax adjustments here, right? Non-cash item depreciation is also given in the question. I have added back. Then I'll be start doing the working capital changes, right? So in the working capital changes, decrease in inventories, trade receivables and trade receivable payables, there might be certain additional information. So we need to construct the working notes for all these items. Now, first of all, we will say what is the inventory of the group at the end of the year, right? So the closing balance is given in the balance sheet, 30,000, and opening balance is also given in the question at 35,000, right? Now there would be certain transactions which might have has happened during the year, right? So inventories acquired during the year, right? So let's see. So 4,000 is the inventory which we have acquired by virtue of the stake from this company, right? So this adjustments we would be making here because this is the 4,000 inventory which we have acquired by virtue of having the subsidiary, right? And we are preparing the consolidated cash flow statement, right? So we are preparing the cash flows for the consolidated cash flow statement, right? Calculating the cash flows. Now 4,000 is acquired and closing balance I have, right? So 30,000 minus 4,000, 26,000 should have been the closing balance. This is a should be closing balance, right? Should be closing balance. But because in my balance sheet, the closing balance is coming as 35,000. So what does this mean? This means that I might have purchased some inventory during the period, right? So that is the decrease in the inventory. So I will treat it. So closing balance, opening balance is 35,000 and closing balance is 26,000. So I might have sold some inventory during the year. So that is the 9,000. So this is how I am computing the decrease in inventory in my working note number one. Now, somebody will ask that all the time we have been straight away doing the opening balance minus closing balance or closing balance minus opening balance to compute the delta between all these working capital items. What is the need to, construct the working note for this inventory? Because in this question, what is happening? We are acquiring certain assets by virtue of consolidating the subsidiary, right? So we have prepared the consolidated balance sheet and consolidated P&L in which our subsidiaries assets are also get consolidated line by line, right? In line with Ind AS 110. Now, because of that, we are preparing the cash flow statement on a consolidated basis, not on individual basis. So when we prepare the statement of cash flow on a consolidation basis, right? So in that case, there might be some movement within the standalone entities inventory, and there might be certain movement coming from the inventory which is coming to us from the subsidiaries line by line consolidation. So to address all these in single go, we are constructing this working note in order to arrive at the right number, right? Decrease in trade receivable. So again, the same thing will happen like inventory. We will again go back to the working note and we will see. So total trade receivables of the group at the year end, closing balance is given in the balance sheet, right? And the opening balance is also given in the balance sheet, right? And subsidiaries trade receivable which we have acquired and consolidated is also given as the additional information to us here. 8,000, right? So this 8,000 we are acquiring from the subsidiary while doing the line by line consolidation, right? So this we have added. So our closing balance minus whatever we have acquired from the subsidiary, if I deduct that, then my should be opening balance is 46,000, but my opening balance is how much? 50,000. So 4,000 is the decrease in trade receivable. So it means ideally my should be opening balance is 46,000, but my opening balance coming in the balance sheet is 50,000, right? So there is a decrease in trade receivable of 4,000 rupees during the year, right? Which might have been collected, right? So I will be going back to the cash flow statement for making this adjustments. Since this is a decrease in trade receivables, again, decrease in trade receivable will be deducted, right? Decrease in trade receivable will be added, right? Like decrease in inventory. So whenever the assets are decreasing, they are always added, right? Now, decrease in trade payables that we need to compute. So again, I will go to the working note, right? So trade payables at the end of the year, 68,000, and trade payables opening balance is 60,000, and trade payables which we have acquired from the subsidiary by virtue of line by line consolidation is 32,000. So my should be opening balance is 36,000, right? But my actual opening balance was 60,000. So there is a decrease in trade payables by 24,000, right? So this is how I am making these adjustments and computing. And now I will go back to my cash flow statement and I present it. Now, because this is a liability item, trade payables, and it is decreasing. So I will simply put it as a negative sign on this, right? So we have to be very careful about the signage of all these items, right? So if any of the signs we are mistaken, then our cash flow statement will not tally for sure, and we will struggle unnecessarily to make it tally, wasting a lot of time in the examination. So please bear in mind these signage has to be right, right? Now, once these adjustments are done, what are the other adjustments? Interest paid to be included in the financing activity. So if any interest is paid during the year, which is given in the question 4,000, right? And the taxation adjustments. So taxation adjustments, how we will be doing? So let's go back to the question to see what information is given around the taxes. So in the consolidated P&L, taxation amount is given as 15,000, which is the provision created during the year, right? And in the balance sheet, income tax payable closing balance as well as opening balance is given to me, right? And I will be using this information. So 11,000 plus 15,000 provision minus the opening balance. So closing balance plus provision minus opening balance, it will be giving me a 14,000 taxation, which has actually been paid during the year. So it is my taxes paid during the year, right? So this is how I will be able to compute my net cash generated from operating activities. So what is the key learning? So key learning is whenever there is a consolidation adjustment, given in the question and we are preparing the consolidated cash flow. So it shouldn't be our working capital changes only. It should also be looked at which all items we are bringing in from the subsidiaries balance sheet while doing the consolidation, right? Because that will also require to be adjusted in order to calculate the right working capital changes, right? Now, cash flow from investing activity. Cash paid to acquire the subsidiary 74,000 minus 2,000. How this adjustment is coming from? So let's go back to the question. So this is the consideration paid 74,000 and this is the cash and cash equivalents which is there sitting in the balance sheet of the subsidiary itself, right? And we have just learned this concept in the previous questions that whenever we are acquiring the control of any subsidiary, then my cash consideration minus the cash and cash equivalents which is coming to me while doing the line by line consolidation of the subsidiary, that needs to be deducted, right? So 74,000 minus 2,000 sitting in my subsidiary's balance sheet. So 72,000 is actually the cash which I have to showcase on my statement of cash flows under the investing activities, right? As a cash paid to acquire the subsidiary, right? And this would be the net cash flow because there is no other investing cash flow information available in the question, right? Now, cash flow from financing activities. Interest paid during the year 4,000. So this information I can look up in the my P&L account, right? So interest is booked there as well. Here it is, interest cost. So interest cost expenses 4,000. So unless and until we are not provided the clear information if there are any payments made during the interest, so we will simply assume whatever the interest expense coming up in my P&L is actually has been paid during the year, right? So I will not say that this interest cost is the accrued interest cost. This might have been paid or might not have been paid, so that I don't need to worry about. So in the absence of additional information, I will simply assume whatever the interest is shown up in my P&L is actually paid during the year as well for the purpose of cash flow statement, right? So here I will be presenting net cash outflow from financing activities because this is a single item. So straight away I can present it at in financing activity line item. Now summation of these three items will give me a positive cash flow of 3,000 rupees. Then I will present my opening cash flow and the closing cash flow. So opening 5,000, closing 8,000. So 8,000 minus 5,000, 3,000. That's what I am generating in the cash flow statement. So this is also my, this is also telling. So this gives me the confidence that my cash flow statement is prepared correctly, right? Are we clear on this? Any questions, any doubts? Try to be responsive in the chat box. Okay, Samanathan, I understand. But I hope you were able to see the solution if your net is not working properly. Okay, okay, understood. Okay. So basically the key learnings from this question are that whenever we are preparing the statement of cash flows on a consolidated basis, that is the consolidated cash flow statement, one additional point which we need to keep in our mind is which all assets, liabilities are coming to us from the subsidiary consolidation, right? Because while making any working capital changes, we need to give effect to those adjustments as well. Otherwise, our working capital changes will be wrong, right? And another item which we need to keep in our mind while presenting the cash flow from investing activity, right? So whatever the cash I am paying off as a purchase consideration minus the cash I am receiving via consolidation of my subsidiary which I have acquired, right? So in this case, we have deducted the cash which was sitting on the subsidiary's balance sheet, which is coming to us via consolidation from the purchase consideration I have discharged in cash to present the investing activity cash outlook correctly. So these are the two special points which we need to keep in our mind whenever we land up in a situation to prepare the consolidated cash flow statement, right? And one more point is, if we are purchasing any additional stake in the company for which we already have the control, then that additional purchase will not be considered as investing activity. That additional purchase will be regarded as the financing activity, right? Like we understood and saw in the previous question, right? So I hope the concepts are now very clear to you. Whatever the concepts we have learned from these questions, I have discussed them in detail. I hope you were making notes in your notepad somewhere for a quick revision. So I think it's time for break. So let's have a break and we will resume the session in 15 minutes, 8:45. Thank you. So before we went on the break, we have done a practical where we have prepared the consolidated cash flow statement and we have learned, few learnings from that practical. Now let's start with question number 6. During the financial year 2019-2020, Akola Limited have paid various taxes and reduced the below mentioned records for your pursual. Capital gain tax of rupees 20 crore on the sale of the office premises at a sale consideration of rupees 100 crore, right? So there is a capital gain tax of rupees 20 crore on the sale of premises for a sale consideration of rupees 100 crore. So one office premises have been sold during the year for rupees 100 crore, on which 20 crore is the capital gain tax. Income tax of rupees 3 crore on the business profits of rupees 30 crore earned during the year, right? So 30 crore is the business income, PGBP income derived during the year, on which 3 crore is the tax liability computed. Dividend distribution tax of rupees 2 crore on the payment of dividend amounting to rupees 20 crore. So during the year, company has made a payment of dividend of rupees 20 crore, on which tax 2 crore has been paid. There is income tax refund of rupees 1.5 crore, which has been received during the year belonging to the prior assessment years, right, on the business profits. So these are the 4 pieces of information available to us, all in relation to the income taxes, right? What is the ask? You need to determine the net cash flow from operating activities, investing activities, and financing activities of Akola Limited under the relevant Ind AS, right? So here, although we do not have any such statement of P&L or balance sheet or additional information given, the straight away the question has only 4 items to talk about. One is the capital gain tax, one is the income tax on PGBP, one another is the distribution tax, dividend distribution tax, and the last income tax refund. So there are 4 pieces of income tax, items which we have to deal with in this question. Now, how you are going to deal with these situations? So capital gain tax, what do you think? Capital gain tax is arrived on the capital gains, and capital gains means we have sold some investments, right? Or we have sold some long-term assets on which the capital gain tax liability has arrived, right? So it means the office premises which we have sold during the year for rupees 100 crore is a cash inflow by virtue of sale of office premises during the year. So in my cash flow statement, I would be presenting cash received from sale of office premises 100 crore. So that is the one line item which I would be presenting. Again, the another item I would be presenting within the investing activity is the tax related to that, because 20 crore is the tax outflow by virtue of this investing activity transaction only, right? So this has to be presented under the investing activity, right? So 20 crore would be the outflow. So I will say in my investing activity that cash outflow on account of capital gain tax payment on the above sale, 20 crore, right? So how I am going to present? Sale consideration 100 crore and capital gain tax paid on that is 20 crore. So both these items are falling within the investing activity. So in the cash flow statement, they will be presented under the cash investing cash flows only, right? Now, business income is my operating activity. So 30 crore is presented as the operating activity cash inflow, and the 3 crore tax liability on that is the operating activity taxable cash outflow. So these are presented under the operating activities. And dividend payments. So when we pay the dividends, so we present the dividend under the financing activity. And if we are paying the dividend distribution tax as well to the government on account of dividends being paid to millions of shareholders, so that 2 crore tax will also forming part of the financing activity, right? So this is how both these items will be presented under the financing activity. And lastly, there is an income tax refund, and this refund also is given in the question that it is pertaining to the business profits so of the previous year. So it is a operating activity, right? So this is how I will present my answer in this case, and the total cash flow is 86.5. Because I don't have the cash and cash equivalent information available, or the working capital changes, or other pieces of information which are required to construct the full-fledged cash flow. So in the absence of that, I will simply be presenting my answer by presenting the treatment of these items only in the question, right? Now, what is the key learning from this question which we have learned? So the key learning from this question is that it's not always hold true that in income tax adjustment will always be part and parcel of the operating activity. So unless and until question clarifies how much tax pertains to which item, we will assume that all of the income tax pertains to the operating activity. But because in this question, the specific pieces of income tax information is available, that how much how much it is related to the capital gain tax, how much it is related to the PGBP income, how much it is related to the dividend distribution tax, how much it is related to the income tax refund of the previous years. So all those specific pieces of information is made available in this question. So we will also consider those pieces as a separate activity, right? So those will not be assumed now a operating activity, which otherwise would have been in the absence of any such specific information made available. So in examination, if we are able to see that there are certain pieces of information available in relation to taxes, then we would be focusing upon the correct classification of those taxes in our cash flow statement. Otherwise, we will lose marks, in spite of the fact our cash flow statement will tally. So cash flow statement doesn't go out if you do the wrong classification, right? So it doesn't matter that whether you are putting a particular item in operating activity, investing activity, or financing activity. Doesn't matter, right? Cash flow statement will anyway tally. So just because we are getting our cash flow statement tallied, it doesn't mean that it is 100% accurately prepared. There might be a mistakes on classifications piece in that statement, right? And if there are any, we will not get good marks or full marks. Certainly there will be deductions. And at least for the purpose of this wrong classification, there will be higher deduction of marks, because we are not correct in our approach, right? So I hope you are liking all these practical questions which the institute has, selected for these LVRC classes, because every question is unique in itself, and they are making you learn, all together all the concepts. They are covering all the concepts from the Ind AS 7, like we discussed on the, when we are purchasing the controlling stake, that would be classified as investing activity, and that purchase consideration will be netted off with the cash which we have acquired from the subsidiary's balance sheet while doing the consolidation. If we purchase the additional stake in the subsidiary, then that will not be regarded as investing activity anymore. That will be regarded as financing activity. If we sell any stake in the subsidiary without losing the control, that will be regarded as the financing activity only. So after the controlling stake is acquired, any further transaction, purchase or sale which is not impacting my control on the subsidiary will be regarded as the financing activity. So that is the key concept we have learned. Then we have also done one question around the forex adjustments, was when we were holding the fixed deposits in our foreign currency bank account, where we have earned interest in terms of dollars, how we have presented those items in our cash flow statement. So all these concepts are unique, and in case you get a full-fledged question in the examination requiring all the concepts available in one question, then probably you will be able to nail it, because you have practiced almost all the questions in this live virtual revisionary classes sessions. Okay, let's proceed to the question number 7. What will be the classification for following items in the statement of the cash flows for both banks and the financial institutions and the other entities, right? So Number one is the banks or financial institution, and number two is the other entities. So both the category of the businesses, we have to decide upon where we are going to present these items in our cash flow statement, whether it will be forming part of the operating activity, or it will be forming part of the investing activity, or it will be forming part of the financing activity, because there might be a change in the classification by virtue of the change in the nature of the business of the company who is preparing the cash flow statement that we have already learned, right? Now, let's start. Interest received on loans and advances given. So I'm reading the question quickly so that you can start making notes. So you can do a uh, bifurcation, FI, and others, right? And you can start putting your classification against each of these items as I'm reading the question, and then we will see the solution and discuss, and then you can match up if you are correct or not. So interest received on loans and advances given. So I'm giving you 10 seconds on each item so that you can think of and note down your answer. Interest paid on deposits and other borrowings. Interest and dividend received on investments in subsidiaries, associates, and other entities. Dividends paid on the preference and the equity shares, including the tax on dividend paid. Finance charges by the lessee under the finance lease. Payments toward reduction of the outstanding finance lease liability. Interest paid to vendors for acquiring fixed assets under the deferred payment basis. Principal sum payment under the deferred payment basis for the acquisition of fixed assets. Penal interest received from customers for making payments late. Penal interest paid to suppliers for late payments. Interest paid on delayed income tax payments. Interest received on tax refunds during the year. So we have all these items, right? And I hope you must have noted down your answers for both the categories of businesses, that is, the others as well as the financial institutions like banks, right? I'm just giving a couple of more minutes to you so that you can ensure that you are done for all the 12 items. And then we will see the solution and discuss the rationale for the classification, and you can match up your answers. Okay. So I hope everybody has noted down, right? Now, first item, interest received on loans and the advances given. So when a bank gives the loan, it receives and collects the interest on those loans and advances given, right? And that is the primary business of the bank, right? So bank operates on this business model only, that they will be giving the education loans, personal loans, business loans, home loans, vehicle loans, right? So all these type of loans they used to give throughout the year with an objective to earn the interest income on that. So that is the core activity, they are running, right? So that is their business activity. So in the case of banks and the financial institutions, it will be classified as operating activity. But if there is an entity who is not a financial institution and he is giving the money to somebody and earning the interest, so it is like investments for them and they are earning the interest income on their investments. So this will be regarded as investing activity, right? So we have to be clear in the examination hall. If the question, suppose we get a full-fledged question and question at the very start says bank, then we should be alert while making the classification for all the adjustments, right? So there might be tweak for various items, right? So we have to be very clear that whether the cash flow statement preparation is required for a banking or financial institution or for other entities, right? I hope this was the easy item. Second, interest paid on deposits and other borrowings. So here it is bank, FI, and it is others. Okay. Interest paid on deposits and other borrowings. So now because bank used to collect deposits from the millions of the customers, right? So on those deposits, they will be paying the interest to you. You must have been receiving the interest on your savings account, FD account, RD account, right? So that interest is the expense, of running the financing business by the banks and the financial institutions. So as they are earning interest, that is operating activity. So if they are paying interest on the deposits, that will also be the operating activity. Why? Because for banks and NBFCs, money is the product. So they are using the money only to generate the profits, right? But for others, it will be regarded as the financing activity. Why? Because we have taken the loans or we have taken the deposits from the small depositors for the functioning of our operations, right? So that is the financing arrangement we have done for our business, right? So this is regarded as the financing activity, right? Now, one more question. You must have heard that many companies is also accepting the deposits from the public, right? So apart from the borrowings taken from the banks or the other financial institutions or the loans taken from lenders, many companies also accept the small deposits from the small depositors, right? So if the interest is being paid on those deposits, that will also be classified as financing activity, because in nutshell, what these other companies are doing. So rather than going to the bank, they are simply getting those funds arranged, from the depositors directly, rather than depositors go to the bank, make FD, and then these banks lend the money to them at the higher interest rate to safeguard on the interest rate. So they are directly accepting deposits from the depositors who are interested, right? So in that case, they are simply doing nothing, but they are taking a financing arrangement, right? Third item, interest and dividend received on investments in subsidiaries, associates, and JVs. Now, for this item, although we understand that financial institutions are running with an objective to generate the interest income, right? But they are supposed to generate the interest income from their normal part and parcel of the business, right? While giving the loans to just the general public or the, companies. But if they are investing in any their subsidiaries, associates, or JVs, and on those investments, if they are receiving any interest or dividend income, then for them as well, this interest and dividend income will be regarded as the investing activity. For others, anyways, it is an investing activity. There is no doubt about this, right? Because anyway, for others, it is always an investing activity. But for financial institution as well, this activity is the investing activity because they are not supposed to do the business with their subsidiaries, associates, and JVs. They are supposed to do the business with unrelated parties or the general public, right? So that's why if we are making any deposits with their subsidiaries, associates, or JVs, or they are giving any loans to their subsidiaries, JVs, and associates, and they are earning interest or dividend on their equity investment from those companies, right? Then that will be regarded as the investing activities only for the financial institutions. So I hope this point is clear to everybody. Any questions? Any doubts? Okay. Fourth item, dividend paid on preference and equity shares, including tax on dividend paid on the preference and equity shares by other entities. So if we are making the payment of any dividend to our preference shareholders or to our equity shareholders, and we are also paying the dividend distribution tax to the government for on such dividends, then that will be a financing activity, irrespective of the fact whether the company is a financial institution or the company is not a financial institution, right? Because dividend paid to the owners of the company, right? And owners had financed your businesses, right? So whatever the return you are paying to them will be regarded as the financing activity only. So irrespective of the fact whether we are preparing the cash flow statement for a bank or financial institution or for any other entity, it doesn't matter. Dividends on the preference share capital as well as on the equity shares along with the dividend distribution tax paid on those dividends to the government will be classified under the financing activity. I hope this is clear to everybody, right? Okay. Fifth item, finance charges paid by the lessee under the finance lease. So what is happening over here? So the company is the lessee and they have taken a property on the lease from the lessor. So they are making the finance charge payment to the lessor. So in this case, what is happening? Instead of purchasing the property, so there are two aspects to this to understand, right? So we shouldn't be learning this, we should be understanding this. So suppose the company has two options, right? So company can either purchase the asset building, right? And purchase the building or can take on lease, right? Now, if they purchase and they don't have funds, what will they do? They will go to the bank, take a loan, right? And the purchase the building, right? Which they want to use. And in other scenario, what will happen? They are, instead of purchasing it, taking on a lease from the lessor. So in either of the scenario or in both the scenarios, what is the true color of the transaction? The true color of the transaction is that the company is in the need of a building and they are getting this building either by purchase or by lease. So both the arrangements, are giving the right to use the building, right, to the company for certain number of years. And since we are taking it on finance lease, we are, trying to finance it instead of owning it. And if we purchase it by taking the loan, in that case as well, we are paying the interest to the bank, right? So in both the cases, it will go to the financing activity because just by virtue of taking the building on lease, I cannot say that the lease rentals which I am paying to the lessor is my operating activity. It is not, because you are getting the building financed, right, by virtue of taking it on the lease. So even if you are taking it on lease, it will be regarded as the financing activity only, right? Irrespective of the fact whether you are the bank or the financial institution or you are the other entity, right? So for both the entities, it will be a financing activity. Payments towards reduction of outstanding finance lease liability. Now, if we are making any payments which reduces our finance lease liability, it means we are doing the repayment of those funds which we had borrowed either by purchase or by taking the asset on lease. So repayment as well as the interest on borrowings, both the items are regarded as the financing activity only, correct? Yes or no? Yes. So whether I am paying the interest on borrowings or whether I am returning the principal amount of the borrowings, both the items are financing activity only, correct? Next, interest paid to the vendor for acquiring fixed assets under the deferred payment basis. So in this case, what has happened? Neither I have taken the loan from the bank nor I have taken the asset on lease. But what I have agreed upon with the vendor that boss, I will be giving you the payments on a uh, uh, scheduled agreed, right? So I'm not making the payments upfront, and because I will be making you payments as per the stipulated schedule, so I will be paying you the interest as well along with. And why I'm paying the interest? Because I have acquired a fixed asset, right? So although I have acquired a fixed asset, and for a fixed asset acquisition is my investing activity, but because I'm paying the interest to finance it, so that interest is the financing activity, right? So interest component is the financing activity always, be it a bank or financial institution or the other entity. It doesn't matter, right? But if I pay the principal amount repayment for that acquisition, right? Then it will be regarded as the investing activity. Why? Because principal is being paid for the acquisition of the fixed asset and interest is paid for financing that acquisition, right? So interest is the financing activity and principal repayment is the investing activity. Is that clear to everybody? So we have to be very careful about the nature of the transaction and the correct classification. Any question on this? Have we understood the point number 7 and point number 8 clearly? Point number 7 is interest payment for the finance of fixed asset. And point number 8 is the principal repayment for that finance. So principal repayment is nothing but the payment of the fixed asset. And interest payment is interest to finance that purchase, right? So that's why these two items are different and not same. So sometimes if we read the question in hurry bari, we might end up looking at the fixed asset, right? That fixed asset is always coming into the investing activity. No, interest is coming in financing and principal repayment is coming in investing, right? Question item number 9. Penal interest received from the customers for the late payments. So what is happening over here? That our customers or the debtors, right, were supposed to make the payment to us on 30th June, but they did not make the payment on 30th June. Instead, they made on 30th August, right? Now, what is happening? I'm charging interest because they have made the late payment. So I'm charging a penalty or interest on them, right? So what is happening over here? My debtor are created by virtue of the sales made to them, right? So whatever the amount I was expecting to realize from them was my operating activity, but because they have not paid the payments in time, I levied a penalty on them. So that penalty will also be part and parcel of the operating activity only because that penalty is coming to me by virtue of my main transaction What is the main transaction? The sale of goods and services, which is my operating activity. So any amounts collected from debtors will always come under the operating activity, right? Penal interest paid to suppliers for late payments. Same thing. So suppose I was expected to make a payment within 60 days to the supplier, but I defaulted and I paid after 60 days. So I made a penal interest. I am liable to pay the penal interest in that case. So most of the times you must have observed that companies, slipped making the payments to the suppliers, and suppliers levy some additional charges or penalties. So, right. So this is by virtue of late payment only. So this is regarded as operating activities only. So suppose one more example I'm taking. So companies are supposed to make their electricity bill payments, right? Electricity bills are not paid in time, and in the next electricity bill, there are penal charges levied, which needs to be paid. How those penal charges will be classified? Operating, because electricity is being used for running the business operations, and the electricity department is my supplier, right? And if I am not paying the supplier on time, they are charging me penalty. That penalty will also be part and parcel of my operating activity, correct? Interest paid on delayed tax payments. So by having only the tax, I will assume it is operating activity. But if the information in the question provides you more insights that what was the nature of the tax payment, suppose it was a dividend distribution tax which you have paid late along with the interest, then it will go to the financing. If the tax was in the nature of capital gain tax which you have made a payment late, then it will be investing outflow, right? So interest on the tax will go into the same classification to which the original tax payment belongs to, right? So in the previous question, we have seen this, that there were three types of taxes: income tax on the PGBP income tax on the capital gains, and income tax on the dividend distributions, right? Dividend distribution tax, we used to call it. So if we are making delayed payments of those taxes and we are incurring the liability of paying additional interest on that, so that will also follow the main classification of the taxes. But in the absence of any such clarity, we will simply assume it is an operating activity, right? But for banks and NBFCs, that is the financial institutions, it is the operating activity. But for other entities, it will again be treated as the financing activity. Now, there is a twist. Why? Because banks, so anyway, are ready to finance by whatever means. So for them, whatever interest they are paying will be forming part of the operating activity. But for other entities, if they are delaying the payments, right? So in that case, what will happen? It will be treated as the financing arrangements from the income tax department itself. So what is happening over here? So this company is saying to income tax department, boss, whatever the liability I owe you, I will discharge late and I am ready to pay the interest. Please allow more time to me, right? So income tax department says, okay, we will be levying the interest for the period for which you would be discharging your obligations. So in that case, I am just simply getting the finance arranged for my business. Instead of paying the cash to the department today, I will be paying it later, and hence I am arranging the finance for my business, right? Interest received on the tax refunds, operating activity and investing activity, because this is the deposit which I have made with the income tax department, and now income tax department is making the interest payment to me. So this is the interest earned on the deposits, like we used to keep our funds in the bank account and we earn the interest. So this is the same scenario. It's just a matter of fact that the party, instead of being the bank, it is the income tax department with whom we have kept our funds as the deposits, because we have made the additional tax payments and now we are getting those refunds along with the interest, right? So I hope the concept around the classification of all these crucial items is now very clear to everybody. Any questions? Any doubts? Any queries? Okay. Let's proceed on question number 8. From the following data, identify the nature of activities as per Ind AS 7. Cash paid to employees, cash paid for development of the property, borrowings repaid, cash paid to suppliers, loan to director. So maybe what you can do, you can simply, as and when I'm reading the question, you can simply start putting your, response to this, whether it will be the operating or it will be financing or it will be investing, right? Bonus shares issued during the year, dividends paid during the year, cash received from the trade receivables, proceeds from the sale of the property, plant and equipment, depreciation of the property, plant and equipment, advance received from the customers, purchase of goodwill, and the payment of provisionary notes. So I'm just waiting for you to note down your responses against each of these items, and then we will discuss one by one along with the rationale. And you can match up your responses if you were correct in your approach or not. So I'm just waiting for you to note down your responses. Take one more minute. I know many of the students must be watching these recorded sessions later, so they can also try when they are watching to note down their responses before looking at the solution. Okay. So I hope you all must have noted down your responses, right? Now let's discuss one by one quickly. Cash paid to employees. So employees are working for you for your business operations. So whatever the salaries, wages, or other employment benefits you are paying to them will be classified as operating activity only. There is no doubt about this item at least. Cash paid for development costs. So what do you mean by development costs? That you are trying to develop certain assets be it a property, plant and equipment, or be it an intangible asset or the investment property. So in that case, whatever the expenditure you are incurring to develop these items will be regarded as the investing activity only for you, because you are developing the property, plant and equipment, intangible assets, or the investment property, whatever it is, right? So that is the investing activity. So either you can purchase these items from the market directly, or you can construct your building on your own. So whatever the CWIP you are creating during the year, right? So that will go to the investing activity. Borrowings repaid. What do we mean by borrowings repaid? So if we have taken any borrowings from any of the lenders, and we are making a repayment of those borrowings. So it means when we took the borrowings, we presented as cash inflow from the financing activity. Now we are making the repayment. So that is a cash outflow from financing activity, right? So there is no doubt about this. Cash paid to suppliers. So suppliers are providing us the raw material or any other goods or services or any other consumables, right? So whatever they are supplying to us, and if we are making any cash payments to them, so that will be regarded as the operating activity. But if the supplier is related to supplying PP&E, right, or intangible asset or the IP, right, then if any payments are made to those suppliers because we have purchased these assets from them, then it will go to the investing, correct? So, but in the absence of any clarity or information, we will simply assume that suppliers are the normal raw material or consumables or goods and services supplier, right? Loan to directors. So what is happening over here? Company has given a loan to a director, right? So director is one of the employee of the company, right? So loans given to director, loans given to employee. What do we mean by this? So because he is our employee, should we regard it as operating activity? No. Are we into the business of giving loans to our directors or our employees? No. So this will be regarded as the investing activity only. So irrespective of the fact whether we are giving or depositing money with the bank to earn the interest, or we are giving it to our employees or directors, or we are giving it to any other third party for earning the interest, it will always be our investing activity, right? So it doesn't matter who is the other party, whether it is a bank or whether it is a director or whether it is a employee or whether it is an income tax department, whether it is a sales tax department, whoever the other party could be. If we are earning any interest on that, that will be investing activity. And if we are giving any funds to them, that will be investing activity, right? Bonus shares issued. So when the company issues the bonus shares, so what happens? Only the shares are issued, there is no cash received. So because there is no cash involved in this transaction, so this is a non-cash item. And once a item is a non-cash, then there wouldn't be any classification applicable. Neither it is operating, nor it is investing, nor it is a financing, right? So bonus shares are non-cash item always, right? Okay. Suppose instead of the bonus, suppose I say company has issued the right shares, rights issue. Then what will happen in this case? Rights issue. What is it? Would your answer be different? Because the company issues the rights shares for some consideration, and that consideration received will be a cash received to the company, right, by the shareholders who have purchased the rights or exercised their rights, right? So in that case, what the company is eventually doing? So company is arranging the finance. So that will be regarded as financing activity. So whether we are issuing equity shares as a initial IPO, further IPO, for private placement or rights issue, by whatever name called, it will always be treated as the financing activity for the company. But if we are issuing the bonus shares, then bonus are always issued for a free. That's what the bonus shares means. So there is no cash received. So this is a non-cash item. Dividends paid. We have already discussed it multiple times. Financing activity, because these are paid to the shareholders from whom we have arranged the funds, right? So this is the cost of the funds arranged. cash received from the trade receivables, operating activity again, because debtors are making the payment to us. So whatever the payments we are receiving from our debtors or the trade receivables is by virtue of the sales of goods and services made to them, right? So that is the operating activity. Proceeds from the sale of the property, plant and equipment, investing activity, no doubt. Depreciation. Now, depreciation is again non-cash item. So since the depreciation is non-cash item, it will not be presented on the cash flow statement as investing, financing or operating, right? It will only be presented as a non-cash adjustment at the top before we start presenting the investing, operating and financing activities, right? So non-cash items are not presented on the cash flow statement under any of the activities. Advance received from customers. So we are receiving the advance from the customer. Now many people will be mistaken in this. So they will consider that we have received the money from the customers and it is a financing for us. No, advance is received from the customer against the agreed goods or services which will be supplied to them, right? So this is not the money which we have received for the sake of generating finance for us. It is the money which we have received to ensure that the customer don't back out from the order they have given to us, right? So that is the some advance we ask for from the customer, so that once we are done with the manufacture or supply of the goods and services, he doesn't back out that he wouldn't be requiring them anymore, right? So the advance is to protect our interest, right? And it is not to generate the finance for the company. And since we are intending to supply the goods and services to the customer in near future, and the advance will be adjusted against the billing of those goods and services when they are supplied, so it will be considered as the consideration received for those goods and supplies, and hence it will be regarded as the operating activity. I hope if the doubt anybody had on this item is now clear to everybody. Right? Purchase of goodwill. So although goodwill is not generally made available in the market, which we can directly purchase, right? So when the goodwill arises, my question to all of you. So goodwill never arises in the standalone financial statements. It always arises in the consolidated financial statements after the acquisition of the subsidiary. So as and when we acquire a controlling stake in a company, right? As and when we acquire a controlling stake in a company, then only if we made the payment of purchase consideration higher as compared to the fair value of the net assets assumed in that business combination, then the goodwill arises. And that goodwill is always recorded on the consolidated financial statements, always, right? Never, you will never be able to see the goodwill on the standalone financial statements, right? Now, my question is, purchase of goodwill means purchase of a company at a cost which is higher as compared to the fair value of their net assets on the acquisition date. That's what purchase of goodwill means. Now, goodwill, if arising, how it will be presented? Because we have disclosed, we have paid the purchase consideration, which is forming part of the purchase of this goodwill. So we will showcase this under investing activity only. But although we are not supposed to clearly mark it as how much purchase consideration we have discharged for goodwill. Simply we would be presenting the purchase consideration discharged to the owners of the company to whom we have acquired the control during the year, right? So that overall purchase consideration will be presented there. It doesn't need to be splitted into the purchase consideration for the other assets and purchase consideration for the goodwill. So that is not the requirement, right? But we have to be conceptually clear that what purchased goodwill means. Purchased goodwill means the goodwill arising after the business combination. Payments of the promissory notes. So if there are any promissory notes, right, and we are paying them, then it is a financing activity because we have arranged the finance only by virtue of having the promissory notes purchased, right? So I hope all these items, so many of the items you must already be, very sure about, but there are certain items which we are, doubtful. And in the examination hall, because we have the lot of pressure to do everything right within the stipulated time, so in doing the things hurry bari, even if we know for a fact all these items, we start doing mistakes, right? For example, purchase goodwill. In the examination hall, we will be surprised to see this item. What does this mean? We have never seen this before in any of the cash flow statement questions we have been preparing or practicing at home, right? So purchase goodwill simply, so nobody can purchase the goodwill directly from the market, and it will create doubts in our mind. What this item is? What should I respond on this? Right? So purchase goodwill. Now I have explained that it arises after the business combination, right? As a differential amount which we have paid as compared to what the net fair value of the net assets was as on the acquisition date, if we have made the expensive purchase. Okay. So I think every item treatment is clear to everybody, and we can proceed on the question number 9. Any doubts, any queries? Okay, let's start with question number 9. One of the subsidiaries of the Buildwell Limited submitted to the central finance its summarized statement of profit and loss and the balance sheet, right? Okay. So what the company is doing? One of the subsidiary of the Buildwell. So Buildwell is the holding company, and there is a subsidiary. Subsidiary has submitted to the central finance its summarized statement of profit and loss and the balance sheet, which is depicted below for the year end 31st March 2003. So they are saying the net sales is this much, less cost of sales, this much, depreciation, salaries and wages, operating expenses, and the provision for taxation. So these are the items they are showcasing as the summarized statement of the statement of P&L. Then the net profit, net operating profit they have computed, sales minus cost of sales, and non-recurring income, profit on sale of the equipment. Equipment means PP&D, right? So they have sold some PP&D during the year on which they have realized some profit, 1,20,000. So 1,20,000 is the PP&D profit they have realized by selling one of the equipment they had. Now the total 8,40,000. Thereafter, the retained earnings and profit brought forward from the previous year, 15,18,000. Total closing balance of the retained earnings, 23,58,000. During the year, they have declared and paid the dividends amounted to rupees 7,20,000, right? And closing balance 16,38,000. So this is the information available to us. Now they have given the balance sheet as well, summarized balance sheet. So profit and loss, property, plant and equipment, land, buildings and equipment, current assets, cash, inventories, trade receivables, advances, total assets, and then liabilities and equity, and then total liability. Additional adjustments which they have given is the original cost of the equipment which was sold during the year is 7,20,000. So 7,20,000 was the original cost of the equipment when the equipment was purchased, right? In 2002, 2003, it is sold. But when it was originally purchased, the cost was 7,20,000. Prepare the statement of cash flows for the year end 31st March 2003. So again, I always say and repeat, we have to be very clear which column is the current year and which column is the previous year, right? So in this case, what is happening? This is the previous year and this is the current year, right? So order is reversed. And if it happens in the examination and we don't notice, then our all the working capital changes which we will be doing will go wrong, and our cash flow statement will never tally, and we will spend unnecessary time to find out what went wrong in spite of conceptually doing everything right. Right. So please pay attention. Sometimes in the examination, these columns orders are flipped, and because of that, our question goes on toss. Right. So I'm just giving you few minutes to try this question on your own first, and certainly I will discuss the solution along with the rationale behind the treatment of each of the item. So I'm just waiting for you to try it once. Okay. So I hope you must have been trying this question on your own, and you must be able to reach to some stage. At least I expect you must have calculated the cash flow from operating activities by now. So just waiting for a couple of more minutes for you to complete your solution, and then we will discuss, and you can simply match if you were right in all the accounting treatments. Okay. I hope you must have been ready with the solution. So let's discuss the solution now. So again, we are going to prepare the statement of cash flow full-fledgedly. So this is a full-fledged question of preparation of the cash flow statement. So we'll start with the net profit before taxes and extraordinary items at 7,20,000 plus 8,80,000, right? So how we are getting this information from? So let's go back. So this is the information we had, right? Net operating profit, 7,20,000, right? 7,20,000 is the net profit which we had, plus we will add provision for taxation, 8,80,000, right? Because this is the provision. So we will compute the profit before tax by doing so. So profit before tax is the profit after tax plus the tax provision hitting our P&L, right? So that will give me a 16 lakh as the starting point, right? Now I will add the depreciation as well because the depreciation is the non-cash item and this must have already been charged in my P&L, which is available to me from this information. Here it is. Depreciation 6 lakhs, right? So this is a non-cash item. I will be adding it back, right? Then I will be starting to make the working capital changes, right? So all the working capital changes I need to make, right? So how much items I have? Inventories, trade receivable, advances, trade payables, outstanding expenses, right? So all these items I need to adjust one by one, right? So I'll start with the trade receivables. So decrease in trade receivables. So in relation to the trade receivables, I will go back to my balance sheet and see if there is any adjustment. No, right? So there is no adjustment prima facie. So simply 2640 lakh was the opening balance and 9,60,000 is the closing balance, right? So the delta between these two items will give me the working capital changes for the trade receivables. So that is the 16 lakh 80,000, right? Now, same approach I will follow for the advances. So advances is how much? Here it is 90,000 and 78,000, right? So the delta between the two is how much? 12,000. So the 12,000 I will be bringing in here as the working capital changes. Now, what would be the signage? Negative or positive? It depends on whether the asset item is increasing or decreasing. And we have to be focusing on which column is the current year and which column is the previous year so that to decide upon whether it is increasing or decreasing. Now, in this case, what is happening? 90,000 is the closing balance and 78,000 is the opening balance. So we are moving from 78,000 to 90,000. It means our advances are increasing, right, by 12,000. So 12,000 advance increased and advances given is an asset item. So what we will be doing in this case, what is the rule? The rule is for all the assets, if they increase, we will deduct. And for all the liabilities, if they increase, we will add, right? So for advances, this is a asset item because we have given the advances. So, and it is increasing. So we are deducting it, the negative signage, right? Similarly, the trade receivables adjustments we will be doing and increase in outstanding expenses adjustments we will be doing by looking at the balance sheet above, right? So here are these two items. Trade payables. This is moving from 24 lakh to 2340 lakhs and outstanding expenses is moving from 2 lakh 40,000 to 4 lakh 80,000, right? So whatever the delta is, we will be considering as working capital changes while preparing the cash flow statement, right? So a decrease in the trade receivables and increase in the outstanding expense, both the items are also coming here. Now, after all the items are adjusted, we will be calculating the net cash generated from operations, right? So it is giving you amount of 38 lakh 68,000. How? We had the operating profit before working capital changes of 22 lakhs plus minus all these adjustments, right? And it will give you the 3868, right? So this is how the cash generated from operations has been computed. Now, we also need to deduct the income taxes actually paid during the year, right? Now, let's go and find out if this information is available to us in the question. So we will see the P&L first, right? So in the P&L, 8,80,000 is the provision made during the year for the income tax, right? And then in the balance sheet, are we able to see anything? Yes. Income tax payable liability. Opening balance is 1,20,000 and the closing balance is 1,32,000, right? So we will prepare the note for the calculation of this item. So opening balance, we will bring in 1,20,000. Closing balance given in the balance sheet 1,32,000 and provision created in the P&L during the year 8,80,000, right? So what is the balancing figure? Balancing figure is the payment made during the year. So are we able to compute this way by constructing the income tax account 8,68,000, right? So this will be the income tax payment 8,68,000, right? So here it is, right? And because this is the income tax payment, so this will be deducted while computing the net cash from operating activities or net cash flow from operations, right? Now the 30 lakh is the net cash which we have generated from the operations, right? I hope all these adjustments are clear to everybody, right? Now we'll start with cash flow from investing. So in the investing, certainly we would be having certain purchase of land, purchase of building, sale of equipment, whatever the information or pieces of information is available, made available to us. So in looking at this, let's first look at the P&L, right? So in the P&L, I don't think any information is given to us apart from the depreciation, right? In relation to the asset. But yes, there is one item, profit on sale of the equipment, right? So it means during the year, there was a sale of PP&D on which we have earned a 1,20,000 profits, right? Now we will see in the balance sheet. So we do have the land, we do have the buildings and the equipment, right? Opening and closing balances. And now let's move to the adjustments part. Adjustment says the original cost of the equipment sold during the year 2023 was 7,20,000, right? So this was the original cost. Now, in order to compute the cash flows, we need to construct the accounts of these two items. So first of all, I will construct the building and equipment account, right? So my opening balance given in the balance sheet is 36 lakhs. My closing balance given in the balance sheet is 56 lakh 70 57 lakh 60,000, and during in the adjustments I am being told that 7 lakh 20,000 was the cost for which the building was sold, right? So what would be my balancing figure? Balancing figure would be 28 lakh 80,000, which is nothing but the purchase made during the year for this building and equipment, right? Now I will also see I will also construct the accumulated depreciation account. So opening balance was 12 lakhs, closing balance was 13 lakhs 20,000, right? And profit, uh, sorry, sale of asset I have made is 4 lakh 80,000 and the profit is 6 lakhs. Now I am able to compute this by having this calculation. So original cost given in the adjustments in the question is already given. 7,20,000 was the original cost. Now less accumulated depreciation, which I have figured out by constructing the account of the accumulated depreciation. So net WDV on the date of the sale is 2,40,000 and the profit I have made by selling this asset is 1,20,000 given in my statement of P&L, which I will add to arrive at the sales proceeds of 3,60,000, right? So this 3,60,000 proceeds I have used, right? Or I have derived during the year, right? By virtue of the sale. So I will go back to my cash flow statement now and I will simply present this item, sale of the equipment for 3,60,000, right? And purchase of the equipment I have already calculated in my working note number 2, which we have just discussed, 28,80,000. So purchase is negative because that is resulting into the outflow. and sale is positive because that is resulting in the inflow, right? Now, purchase of land is also there. So if I go to the balance sheet, I am able to see that opening balance was 4,80,000 and closing balance is 9,60,000. So it means during the year I have purchased the land as well. And because we know for a fact that we don't charge any depreciation on the land, so there wouldn't be any depreciation adjustments or working notes required. So we can simply take away the difference from these two balances for the land, and hence we will be able to get it on the investing activity. Purchase of land 4,80,000, and because this is a purchase, so this is resulting in an outflow of the cash, right? Now, summing up all these three items, we will get the net cash used for investment activities, right? 30 lakhs. Now we will reach and see to the financing activities. So during the year, we will check on the balance sheet if there are any movements in my equity share capital, right? So where is my equity share capital? Here it is. Share capital. So I am able to see that my opening share capital was 36 lakhs and my closing share capital is 44 lakhs 40,000. So it indicates there are some movements in the share capital have happened during the year, but might be by virtue of issuing the shares for cash or might be by virtue of issuing shares for bonus or right. Then I will see if there is any additional piece of information given to me in the question. If there is nothing, then I will simply assume these are the fresh issue of shares for cash and I will not assume these are the bonus issue, right? So looking at the adjustments, there are none. So I will simply say whatever the delta is belonging to the issue of share capital during the year. So I will bring in the delta here, 8,40,000, and during the year dividends paid is 7,20,000, which is given to me in my P&L here. Here it is. Dividends declared and paid during the year, 7,20,000, right? So this is again the financing activity. So I will present this also in my financing activity. And my net cash flow from financing activity would be positive 1,20,000 because I generated the cash by issuing equity shares 8,40,000 minus the dividends paid during the year. So 1,20,000 is the net cash inflow from the financing activity. So net increase in the cash and cash equivalents is 1,20,000 because I had 30 lakh positive cash flow from operating and I had negative 30 lakh cash flow from investment. So the only 120 is the net cash inflow and outflow or cash inflow I have generated. Now opening cash and cash equivalents balance from the balance sheet and the closing cash and cash equivalents from the balance sheet I will be presenting here to see if my cash inflows, net cash inflows are correct, right? So that is anyway correct. So this is how we are going to present our cash flow statement with these working notes, because if we don't do the working notes, right, then the chances are that we would be doing the wrong adjustments, number one, and number two, our presentation lacks. So examiner might be believing that in the absence of any working notes, how really we computed these items or balances, that is doubtful, right? So we always should present our working notes duly supported by the referencing in the cash flow statement, right? So we should always be giving the references as well to which working note, examiner should refer where we have computed this item, right? So that he can simply see. So I hope you learned all the concepts which we have discussed, which we need to keep in our mind while preparing the cash flow statement. And the session was informative and useful for everybody. So with that note, I wrap up the session and wish you all the very best for your examination. Session over, Ashok ji. Thank you.